Hello and welcome to the session. Financial Management LO4 recommend alternative investment appraisal techniques to inform decision-making. How do organizations decide where to invest their limited resources? Investment appraisal techniques guide these decisions, ensuring projects align with strategic goals. This video explores various methods to evaluate investment opportunities. Every investment choice involves opportunity cost, meaning resources used here can't be used elsewhere. Financial management evaluates if an investment is the best use of capital. This is crucial for capital-constrained organizations. Misallocation reduces future growth potential. Appraisal techniques help compare projects and align them with strategic objectives. The payback period measures how quickly an investment recovers its initial cost. It's simple to calculate, making it useful for liquidity-focused decisions. It's recommended where liquidity risk is high. However, it ignores returns beyond the payback point. Thus, it's not suitable for long-term investments as a standalone tool. ARR measures average profit as a percentage of initial investment. It focuses on profitability rather than cash flow. It's useful where accounting measures are prioritized. However, ARR ignores cash flow timing and risk. This can distort decisions, especially where depreciation methods vary. NPV calculates the present value of future cash flows using a discount rate. A positive NPV indicates added value. It's the most robust technique for long-term decisions. NPV accounts for time, risk, and opportunity cost. However, it relies on accurate cash flow forecasts and discount rate assumptions. IRR calculates the discount rate at which NPV equals 0. It represents the expected rate of return. IRR is useful for comparing projects and communicating returns. However, it can be misleading for projects of different scales. It assumes reinvestment at the same rate, which is often unrealistic. The Profitability Index measures value per unit of investment. It compares present value of inflows to initial cost. PI is useful where capital is limited. It ranks projects based on efficiency. However, it may favor smaller projects over larger, strategically important ones. Investment decisions are influenced by expected return, risk, and time horizon. Cost of capital and economic conditions also play a role. Strategic alignment and sustainability are important. Non-financial considerations like operational capacity matter too. No single technique suffices. A combination is needed. Non-discounted techniques like ARR and payback are simple and quick. They're useful for screening decisions. However, they ignore the time value of money and risk. This makes them unsuitable for strategic, these long-term investments. They're best for initial filtering. DCF techniques address weaknesses of non-discounted methods. They recognize that future money is worth less than present money. NPV and discounted payback are key DCF methods. They account for time and risk. However, they rely on assumptions, making them complex. Inflation affects cash flows and discount rates. Cash flows should match the type of discount rate used. Taxation impacts cash flow estimates. This includes tax on profits and savings from depreciation. Ignoring tax can overstate returns. Investment appraisal must reflect uncertainty, adjust cash flows for risk, or increase the discount rate for riskier projects. Use sensitivity and scenario analysis. These techniques assess how changes affect outcomes. They help understand downside risk. No single technique provides a complete answer. Use NPV as the primary tool, supported by IRR and discounted payback. This ensures decisions account for value creation and liquidity risk. It also considers uncertainty and opportunity cost. This supports sustainable performance. Expected return influences investment decisions. Organizations need to know if a project generates value above its cost. NPV is most appropriate for measuring absolute value. PI is useful where capital is limited. Payback and ARR are less suitable here. Risk level strongly influences decisions. Projects with uncertain cash flows need methods recognizing risk. DCF techniques like NPV are appropriate. Use sensitivity analysis alongside these methods. Simple payback may prioritize rapid recovery but shouldn't be used alone. The investment's time horizon affects technique choice. Short-term projects focus on liquidity. Long-term investments require time-based valuation. Payback and discounted payback are useful for short-term. NPV and IRR are better for long-term projects. Cost of capital influences investment acceptance. Efficient capital use becomes critical where funding is scarce. NPV should be prioritized as it incorporates cost of capital. PI helps allocate limited funds efficiently. Use IRR with caution in varying cost scenarios. Organizations under cash flow pressure may prioritize quick returns. Payback and discounted payback are appropriate here. They ensure funds aren't committed too long. However, they should be supported by NPV. This avoids rejecting high-value projects. Some investments are driven by strategic necessity. These include compliance, sustainability, or technology upgrades. NPV remains useful for financial impact. Qualitative assessment complements quantitative appraisal. Scenario analysis provides insight into long-term implications. Adopt a layered approach for long-term capital expenditure. Use payback period for initial screening. NPV should be the core evaluation tool. IRR and discounted payback assess return quality and liquidity risk. ARR helps understand accounting impact. Prioritize DCF techniques, particularly NPV, for long-term decisions. Use non-DCF techniques as complementary tools. This balanced approach reduces short-term bias. It improves capital allocation and supports sustainable performance. NPV should be the primary decision tool. In conclusion, investment appraisal techniques are essential for evaluating the viability and potential return of investment opportunities. By recommending alternative techniques such as payback period, net present value, internal rate of return, and accounting rate of return, organizations can assess risk, profitability, and long-term value. Using a range of appraisal methods supports more informed and balanced decision-making, helping organizations select investments that align with strategic objectives and financial constraints. Effective investment appraisal contributes to sustainable growth and improved financial performance. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07484361688.